Hello and welcome. You're tuned into CNBC TV18 Prime. Let's get cracking on a brand new episode of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, currencies, and crypto. Well, quick look at the global equities first, and the Wall Street coming off a rather volatile week of trade as all three indices closed with significant cuts, pausing weeks of positive moves for the broader market. The S&P 500 ended the week down 2.4%, notching its worst weekly performance since May 2023-2025, while the 30-stock Dow Jones Industrial Average dropped by nearly 2.9% to post its worst week since April 4th. The Nasdaq Composite also ended the week down 2.2%. The stock futures, however, are higher as uncertainty over the U.S. economic picture continues to mount. Signs are up of the mixed trades in Asia as well, with sharp cuts on the Nikkei. The Shanghai has shut shop with gains of little over 0.5%, as you can see on your screens there. Well, let's shift focus now to the crude oil markets. And amid increasing pressure from the United States to halt oil purchases from Russia, 8 members of the OPEC Plus have announced another large output hike of around 547,000 barrels per day for the month of September as well, the latest in the series of accelerated output hikes to begin market share. The move marks a full and early reversal of OPEC's largest tranche of output cuts, plus a separate increase in output for the United Arab Emirates, amounting to about 2.5 million barrels per day, or about 2.4% of the world demand. The prices of crude oil have extended declines on the back of that OPEC Plus hike in sense of production. Bob Yawger, ED of Commodity Specialist, Mizuho Americas, now joins us to talk further on that. Bob, hi. It all has been about the crude oil prices over the weekend. While OPEC Plus has come out and increased production pretty much as expected, it really is about whether or not those sanctions come in on Russia. If that happens, then OPEC does want to be in place to increase their market share. How are you reading first the OPEC Plus increase in production?
Well, it was widely expected, so it's not a big surprise. We are trading $67 here in the States, about $70 an international Brent barrel. That's not a big number. We were trading significantly lower a couple months ago when this cuts started to be unwound. At the same time, if you remember correctly, President Trump was threatening his tariff situation, and we traded down to about $60, below $60 international benchmark Brent. I think at the end of summer here, at the end of summer driving season, once fundamentals start to unwind and start to weaken somewhat, less crude oil starts going through the refinery, I would expect this market to come under pressure.
Bob, when you say the markets can come under pressure by the end of summer, what kind of levels are you looking at then?
I'm looking like revisiting those sub $60 for Brent. That would be about $55 for WTI. That's the United States barrel. We could see levels down, spikes down to as low as $50 in Brent, in my opinion. Basically, at the end of the day, according to the International Energy Agency, we will have about a 2 million barrel surplus in supply versus demand every day in the fourth quarter. That's where the danger zone is. That's when we start to see some big weakness in the market. The refineries are shut down at that time of the year. There's nearly no demand from driving season. We haven't entered winter heating season yet. Less crude oil goes through the refinery. That oil that would usually go through the refinery is sent into storage instead. And that's going to be a dangerous period. That's going to be a rough ride right there.
Bob, that's one scenario to look at it. And if everything goes well, if there are sanctions, and yes, markets are pricing in a very, very small percentage of that. But if that happens, there's also this conversation about crude oil prices going above $100, even if it's for a knee-jerk reaction. Do you see that happen? Are you pricing in that worst case scenario?
I don't think that's going to happen. Okay. First of all, keep in mind that we've had sanctions on Russia. This is what, the 8th round of sanctions on Russia, and it really has not done very much. Supposedly, these ones are going to be tighter, and the big victim to all this, the country that will suffer the most, would ultimately be India. Under the new Trump plan, anybody that buys Russia's oil and sends those barrels to the refinery will be sanctioned accordingly also. And India is one of the bigger buyers of Russian crude oil on the planet. So that would be an issue for India. But you keep in mind, the OPEC folks still have 1.66 million barrels of crude oil that they took off the market earlier in 2023 to combat low oil prices. There was talk after yesterday's meeting that they are going to start talking about those barrels at the next meeting on September 7th. I think that they have brought this up and they have this hanging out there in the future as kind of a counterpunch in case the Trump administration really does lock down those Russian barrels. So you have 1.66 million barrels of OPEC barrels that they took off in April of 2023 on the horizon a little bit. And then you also have Saudi Arabia in 2023 unilaterally made a 1 million barrel cut also. So that is also looming out there on the horizon. They could bring that back also. Listen, at the end of the day, there's a lot of crude oil on the market. The United States' production has come off about 300,000 barrels from the all-time record of 13.6 million. We could easily bring those 300,000 barrels back if the price is right. So do I think $100? I don't see that happening. There's just too much crude oil in the world. You could probably see spikes up to 85 bid at 90 in Brent. That'd be 80 bid at $85 in WTI. But I don't see us getting out of control here and going to $100. That'll only bring more oil back on the market. That would only kill the golden goose.
Oh, well, yes. Bob, you talked about India, and well, yes, India's import from Russia, pre-2022 was less than 1%. It's come to 35-40% in the first half of this year. So, well, yes, that has been a huge, huge jump. And why not? Because we're getting discounted barrels there. If India, again, there are a lot of ifs and buts here. So if India is in some sense sanctioned and told not to buy from Russia, one, do you see that happen? Because if that happens, then that means $9 to $10 billion of more payment from India to the world to buy crude.
Yes, I think it's possible. I don't think it's likely. I think there'll be some kind of terms when push comes to shove. India will be given something like 6 months to walk away from those barrels. That'll extend the timeline out for Russia to negotiate a deal with Ukraine. I don't think we're going to get there in what is it now? It's going to be 6 to 10 days away till the Russian sanctions possibly kick in. There'll be a timeline extended on that. That's the way the president negotiates, generally speaking, gives everybody time to maneuver, change their whole situation. I don't think he's going to, on the sixth day from now, say, okay, this kicks in tomorrow, and if you're still buying those, if India's still buying those Russian barrels, then you're going to see some sanctions slapped on you accordingly. I don't think it'll work like that. It'll be a situation that will encourage India to walk away from Russia. India will have to decide if that's something they want to do. They have to decide if they want to take the hit from sanctions from this Trump administration versus getting those barrels cheaply. It's not a clear-cut answer whether that's a yes or no situation, and proceed accordingly. I think this will ultimately be worked out, and I think we'll have a good situation where India can find those barrels, stay with the Russian barrels, and proceed accordingly. It's just too good of a situation for India to walk away from. I do understand and I do realize that there are banks that will not lend some of the Indian refiners the amount of capital that they need to move forward. But that has to be weighed against how cheap those barrels are. Let's say Russia increases the discount by another 5-10%. That just makes it hard for India to walk away. There is a pseudo buy India movement inside of India that's being talked here also by the leadership in India. And so that could be the answer also. That could be the Indian counterpunch also.
The other thing, Bob, to look for is, of course, with U.S. pushing for higher crude imports or exports to India. Well, of course, we've seen that number increase or grow as well. Do you see that line being towed in?
That could be the ultimate bottom line here at the end of the day. But I mean, that's very difficult. It's expensive for the an Indian refiner. It's expensive for Reliance to send a big 2 million barrel a day crude oil tanker all the way to the United States to come all the way back to India. That's cost of carry. That's what's called cost of carry. And that is just, it's too expensive to go for an Indian refiner to go all the way to the United States, pick up crude oil, and bring that all the way back to India. Now, of course, if that's if the folks in Amsterdam, Rotterdam, Antwerp, what's a very large refining area, if they start buying all the Indian or all the U.S. barrels, then the Indians can buy more Middle Eastern barrels. The barrels that the Europeans wouldn't buy from Middle East, that market would open up somewhat, and the Indians could step into that space easier. It would be easier for them to do so. Now that could happen. That's the arbitrage situation. That arbitrage moves back and forth. In my business, this is one of the big moving pieces of oil on any given day versus cost of carry. The ARB has to be cheaper than cost of carry for the Indians to go all the way to Texas, the Texas coast, to buy those barrels, go all the way around South America, because those tankers are gigantic. Not all of them can go through the Panama Canal, and go all the way back to India. That's not exactly down the street type situation. So it's expensive. I don't think they're going to be buying U.S. barrels for size anytime soon. But that'll shift the arbitrage situation across the planet, and it could be a favorable type of situation for India.
That's very, very well put. Yes, it's not across the street. It's going to be a very long haul. But that's exactly what the U.S. perhaps seems to be pushing for. And we don't know how much India will really start to buy from there, Bob. But, you know, as a best case scenario, or in a perfect world, how would you look at India really diversifying its origin countries here?
I would think the best possible scenario, which would probably keep the Trump administration happy, would be for India to start buying more barrels from Saudi Arabia. Saudi Arabia barrels that are currently going to the Middle East, we would move more, the United States would move more barrels to the European Union. They would run more U.S. barrels than Europe. And I think that would be ideal. That's the best possible scenario, in my opinion. That would lower their reliance on the Russian barrel in India. And I think the Trump administration would be happy with that. I don't think that the Trump administration, at the end of the day, they understand the mathematics here. They're not expecting India to go all the way to the United States and start loading up for size in the next 15 minutes. That's not going to happen. You may see India go to the United States and pick up particular types of crude oil, high quality crude oils that they can run through the refinery. And it makes it, and it actually comes out mathematically in India's favor for a couple barrels. But to go for size, that's not going to happen. Now, it's a game of whack-a-mole to a certain degree. But if they start buying Saudi Arabian barrels, and that loosens up the Russian relationship, and then those Saudi barrels don't go to Europe, then somebody's got to feed Europe, and that's the key right there. That would be the United States. Even that arbitrage is not a layup, though. That's still like 50 cents. Right now, it's probably 50 cents to $1 against Europe for size. But if that starts to loosen up India via the Middle East, then maybe we'll clear up that 50 cent to $1 arbitrage. In other words, right now, if the European Union refiners going to the United States for all their oil, they're basically getting beat about 50 cents to $1 per barrel.
Well, that would all make sense, and I hope people do look at that more sensible opportunities and, of course, resolutions to a lot of things that are happening at this point in time. But Bob, as always, thank you so much for making sense of that. Well, yes, we've discussed the best case and the worst case scenarios and what perhaps could happen and what could happen. Let's see on what really transpires or conspires in next week or a month, and that is when we would know. But with that, it's time for a very short breather on the show. On the other side, we will be joined by Peter McGuire of Trading.com. Stay tuned. We'll talk all things commodities with him. Welcome back. Joining us on the show now is Peter McGuire. He's CEO of Trading.com. Peter, hi, thank you for joining in. And while, of course, we will talk various other commodities, but you heard Bob, and he was talking about a possibility perhaps of a $60 or a $55 a barrel for WTI in the next couple of months and not 100 as various reports do seem to be suggesting. What is your worst case, best case scenario and your prices within?
Well, good afternoon, Manisha. I listened to the whole interview. Bob is certainly on the money, isn't he? When he speaks about it from, a US perspective and so many different frameworks. There is no doubt in the way it's going. I think that you will see that glut end of Q3, start of Q4. And if that's the way it goes, everyone's calling 60 and sub 60 as the handle will be at going forward over probably the next two and a bit months. So from that sideline, I would think if there are no geopolitical or any issues as far as disrupting supply, then that is I think that the best case moving forward and the best case scenario, Manisha, is going to be sub 60. If something was to derail with weather outages and, of course, with geopolitics, then that changes the footprint. But I think we're in a downdraft, and it's certainly volatile, what we've seen in the last couple of trading sessions.
Oh, absolutely. Peter, with you, I want to focus on gold, though, because we've seen the U.S. Fed meeting, and then we've also looked at the U.S. jobs data that came in on Friday with the revision, not just for this month, but the previous 2 months as well. Now, that doesn't augur well and tells you that there is a definite slowdown, especially when it comes to labor market. And then the expectations of a rate cut in the month of September definitely seems to be boosting the gold prices. How have you read, the labor market numbers and your reaction to gold moves?
Well, exactly right. I've seen the 10-year get crushed a little bit to the downside, and US dollar certainly was sold off. So there's the first part of those. Second part, we had gold, and gold was punched up. It was very disappointing when you're looking as far as those July NFP figures, Manisha, 73,000. I expected, the sort of talk of the town was 110. And as you mentioned, May and June were revised very fiercely to the downside. A lot of those jobs that were lost were government jobs. And the other side of it is going to be, how does the next, this is summer, how is September going to look, or August going to look in early September? Now, when we look at rate cut perspective, everyone's very focused that it's about a 90% probability you'll see a cut in September. No meeting in August because of Jackson Hole. So that September is going to be really a focus. We've got also about a 45% probability of another rate cut sometime in the back end of 25, Manisha. So that's where they're reloading it. Some people say the Fed's behind, or is it in front? It's so difficult to really give it, I think, the interpretation. They got some hard, and there was also dissension with as far as some of those members versus the general consensus of the Fed.
So what's your sense on the prices then? Because we've seen a smart uptick come in for gold, 2% of gains on Friday, and it seems to be holding well right now. Are you looking at this rally continuing now?
Yeah, I think so. I think, it's got probably a little bit more momentum. I still hold, hand on heart that it's very much a 36 to 3,800, and I think that'll be achievable, certainly 3,600 sometime over this quarter, and I think it really starts to ratchet up as far as positioning and, appetite going into Q4, and that over that Q4 period, I think it's going to be showtime. I think that's when you see a big blast to the upside, a couple of $100. I won't be surprised. I think silver will go up as well. And the overall theme is going to be, you start cutting rates, people are going to be conscious of it. And let's see how the labor market is. The back end is going to be just as volatile, if not more volatile, than the first half.
And a bit of a decline that we've seen in the dollar index. I mean, it reached 100, above that as well. Yeah. And now we've seen some decline coming in. All reaction to the U.S. jobs data. How are you looking at it ranging going forward?
Well, I think it's going to be sold, and I think it'll probably continue that, sell-off and a soft sort of take out 97 to the downside, Manisha. I think that's probably very achievable again over the next month and a half, leading into that meeting into September. If they cut rates 25, they may surprise. Who knows? I might do 50. But the overall theme, I think, is going to be one of soft dollar. And let's just see where it rolls over the rest of September, leading into the back end of Q4. So I don't see the dollar being over 100 anytime soon. It had a little run up, as you mentioned, in the last few days, and then it was really spanked down. 98 sort of 50, 98.60. That's how it was in Asia trade early this morning. It's bounced a little bit back to the upside, but I can't see it getting through 100 anytime soon.
All right. You mentioned earlier that you're also bullish in silver. We've seen some profit taking here, and it's getting bought into on the lower side again. Silver clearly taking some cues from the base metal prices also, and because we saw some profit taking there, silver took that too. How are you looking at silver prices? And more importantly, where do you see a support come in?
Look, I think silver's going to be the tear. It's going to be fantastic over the rest of this year, Manisha. All the ingredients that go into the manufacturing, the appetite, the demand picture. I just think it's a perfect storm. So I think it's going to be above 40, probably the early start of Q4, and then it's got the capacity to probably put a couple of dollars on, dependent upon gold and the other, what happens with the rest of the market. The positioning of it, look, it's probably just, profit taking. And I noticed that it's, back at that 37 and early $37 handle. It's given up some of that hot steam, but hey, that's what markets are. They're volatile, and that's the opportunities that allow traders to make a dollar out of it, or a rupee.
Well, after the 24% decline in COMEX copper, Peter, in the previous week, would you say that much of that pullback is done, or are we expecting some more? Especially with the fact that much of that copper from US perhaps could come back into the global markets, putting pressure here as well.
Absolutely. What we saw when President Trump mentioned that 50%, Manisha, and went from 440 or something up to 560, 570, I think it was, and then it's all been stripped back out. So, it's incredibly volatile, but the London Metal Exchange didn't trade. We all understand the positioning and how that all more or less happened. So where we sit from here, I feel as though I just want to get through the next couple of weeks and get a real indication what's going on as far as global demand, where we are as far as price. And I still think that, copper's probably got the capacity to be through 10,000 a metric ton relatively soon, sometime over, the rest of this quarter and maybe early into Q4. So, industrial metals are very much a place to be. And, you can't write them off. There's hot demand for it.
Peter, I also want to get a sense on platinum, because after making those very strong gains in the previous quarter, we saw July kind of consolidate with big moves continuing there. How are you looking at this metal going forward? I mean, has it done it? Has it made its spike, or do you think it's still in place?
I think that it's a play still in. It's still in play. Okay. But the old, when you see it, Manisha, I mean, we had such a big run up. Markets get exhausted to the upside. Other dollars are to be made. People may have margin calls and all of those sort of moving parts that go into the trading environment. So yes, I think it's probably got the capacity to have another leg up. It'll roll. If it's little brother and it's very little brother, it's gold and silver get a hurry up, then it's certainly, platinum will take another run. So don't wipe it off yet. This year's got a lot of moving parts. We've got to see how the tariffs play. We've got to see what happens with non-farm payrolls and, of course, with GDP in the States and CPI. So there's a lot of big themes going on, and I think the back half of the year is going to be really exciting.
Well, yes, there's too many moving pieces in the puzzle there. But thank you, Peter, so much for joining in. You've given us targets and rates and ranges for various commodities there. Crude oil price as well. If all dust settles, we could be looking at prices going to 60 or sub 60 as well. 90% probability of a rate cut in the month of September. And it's still a buy call continuing from Peter when it comes to gold, silver, copper, platinum. Those are some of the metals to keep an eye on. Peter, as always, really appreciate your time here at CNBC TV 18 Prime. With that, it's a wrap on this episode of Big C. Thank you so much for watching.